I know we all like to just see it run up, but quite frankly, I'd be glad if it traded between 3,000 and 3,500 through the whole summer, because that would get us to that 4 or 5,000 that I still think is a very reasonable price expectation. There's a changing of the guard here. People have to understand that people have the money. Now, you're a Bitcoiner and all, you can do all that argument. Still, the people that have the money are central banks. They're not buying Bitcoin. They're buying gold, and they're buying it in huge quantities. And until that changes, there's only one way gold can go over the long term: higher. What level it gets to, we don't know. We've never been up here.
The technical pattern of multi-year bases and subsequent absolute and relative breakouts is highly reminiscent of the pattern experienced by gold at the start of the century, which took the yellow metal from its breakout at $500 in 2004 to significantly higher prices. Gold has been a significant outperformer in 2025 as geopolitical tensions and instability have driven a rush to the safe haven precious metal. Renowned expert Peter Grandich states that Trump could have done more if elected 10 to 15 years earlier, before global fragmentation. He mentions that in 2021 he sold stocks for gold, citing fears of de-dollarization and the rising influence of BRICS. He predicts more nations will move away from the US in the next 6 to 12 months. Although the threat of de-dollarization and a digital BRICS currency does not appear imminent, there is no doubt about the commitment, particularly by China and Russia, to create an alternative to the existing financial architecture. From a technical perspective, Grandich notes that gold has outperformed stocks and bonds since 2000, although many in finance are unaware of this. Drawing from past market history, he suggests gold isn't trapped in a narrow price band, seeing $5,000 as a reasonable target. He argues that central banks are not Bitcoin buyers but rather driving gold demand by buying in massive volumes. If the public added even 1 to 2% gold to portfolios, he believes it would supercharge the bull market, which he thinks is far from over. Central banks have emerged as a driving force behind the record-breaking bull market for gold, and while the true scale of their buying is shrouded in mystery, nobody expects them to stop. Globally, they are accumulating roughly 80 metric tons of gold a month, worth about $8.5 billion at current prices. Ultimately, Peter Grandich views early signs of a long-awaited bull market in junior resource stocks. Before we dive into Peter Grandich's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Yeah, I think if Trump got there 10 or 15 years earlier, he would have been able to do more, but so much has been etched in stone, so to speak. The world was already going into a split up. One of the things that, and I know you probably asked later on about gold, but one of this, in fact, the most single important factor that got me to even buy gold for capital appreciation in 2021 and sell stocks and bonds was the belief of the division in the world breaking up away, de-dollarization and BRICS. I've been a huge believer in BRICS. I'm not rooting for them. It's not going to help me as an American, but I do think it's something that's underway and will continue. In fact, I think if I was the head of a membership drive in the BRICS, I'd have a very big smile on my face, because I think there's going to be more countries after the next 6 to 12 months looking to move away from the United States than getting closer with the United States. So I think that's an important part, that world commerce is changing away from the United States being the dominant leader at a time when there's starting to be a fair argument. Is it also losing its prominence as the world's #1 economic and potentially even military power? So I think these are things that the U.S. stock market has not yet come to gripes with, but I think the undertones and things that we're seeing, especially because of why the metals have acted the way they have, and even the dollar not performing well, after spending years as a money manager at PDAC, praying it would get over 400, and then a few years later, maybe 500. I think we got to be appreciative that it's still at $3,300 when it was just 2,000 less than 2 years ago. I think one of the reasons people aren't as anxious now that the gold prices come off a little is because the other things they tend to own are doing better. Certainly the major mining shares are, and even the junior market is starting to get a lift. And I know you focus in an area like that. But don't take away the fact that gold has done tremendously. You know, I hear these, I call them the don't worry, be happy crowd that makes up much of my financial service industry, those folks that have only been in it since the new millennium. And whenever I ask them, what was the best performing investment you could make? And they go, either stocks or bonds. And I say, you know that gold's outperformed stocks and bonds since the year 2000. They go, no way. and then you show them statistically the fact. I'm very happy and content on what it's done. It's had the corrective phase. In fact, I keep telling everybody, the longer we go sideways here, the higher we can go after this correction and consolidation is over. And silver. Now, Kai, I used to get hated by the silver bugs because my standard line was silver's like kissing your sister. I used to say, oh my God, after I got off the stage, they wanted to kill me and all. But I always chose gold over silver. No, silver now belongs in the same room and maybe on the same line as gold. That's how well it's gotten. And it's trading okay. And of course, copper, which was my favorite metal for 2025. So, folks, hey, listen, I know we all like to just see it run up, but quite frankly, I'd be glad if it traded between 3,000 and 3,500 through the whole summer, because that would get us to that 4 or 5,000 that I still think is a very reasonable price expectation. There's a changing of the guard here. People have to understand that people have the money. Now, you're a Bitcoiner and all, you can do all that argument. Still, the people that have the money are central banks. They're not buying Bitcoin. They're buying gold, and they're buying it in huge quantities. And until that changes, there's only one way gold can go over the long term: higher. What level it gets to, we don't know. We've never been up here. But here's the thing I need to add, if you give me this extra minute. When I entered the brokerage business in 1984, Kai, the Dow Jones Industrial Average traded between 700 and 1,000 for 12 years. A guy came out in 1985, 86. No one heard of him, Robert Prechter Jr. And he said the Dow's going to 3,600. And he used something no one knew about at the time, Elliott wave theory. And I remember the Wall Street Week and Louis Rukeyser and all those guys. This guy's nuts. The Dow never really gets over 1,000. How's it going to go to 3,600? It went a lot further. I'm not saying gold's going to 40,000 too. What I just think gold people have to get out of their mind is it's not trapped between number. It doesn't have to just stay at such a price. Look what this physical demand has done. Can you imagine if the public at large, who still are basically net sellers of it, can you imagine if they just decided to add 1 or 2% in their portfolio of gold on top of everything else? It's still a very, very bullish scenario. We haven't even gotten halfway through this bull market, in my opinion. In our business, the first thing we tell you, we don't believe in cookie cutter approach. So we don't think there's one allocation that fits everybody. First thing is we'd ask you, do you have a lot of debt? If you do, pay it down, because that's an investment in itself, mentally and financially. Second is, do you spend less than you make? Now, if you meet all those things, and you are showing that you're saving for retirement, you're not taking from the kids' college fund so you can go out and buy an extra car or something. If you meet all those things and you say, okay, I want to try to turn this into something, I go back to what we started out earlier. Capital preservation now is more important, and the older you are, the more you have to err on that side of caution. It's not how much you're going to make, it's how much you don't lose, which is likely to separate you from the winners or losers 5 or 10 years from now. With that in mind, I've not advised any U.S. equity holdings since the start of the year. I think there's better markets around the world. I'm a big believer of the Chinese market, if you can believe that. Singapore, some other countries. So any type of fund that's ex-USA, I'd be a holder of. I'm a big believer here for U.S. citizens on equity index annuities. While it caps their gain possibility, it also stops no principal loss. Outside of that, I still think that the areas where one can make money in still is in the metals. And now, thankfully, and I may be singing a little bit to the choir here, after the bearish of bear markets, of the beating of all beatings, even I, after 40 years, took the junior market, the junior resources finally lifting. Not taking off yet, but lifting. And what's important about that is when gold went down in these recent days, those shares didn't. And that was never the case. People used to get mad. Gold was up $30, their stock was up 2 cents. Gold went down $10, their stock fell 10 cents. Now those juniors are holding their own, or actually rising, even if the metal isn't. So I think the day in the sun finally, and remember this, and you've been around long enough to know this, bull markets in juniors are a lot shorter than bear markets. So don't get too caught up in it. Be thankful it happens. But I do think we're on that verge of that long-awaited, many years waiting bull market for junior resource stocks.
Based on global uncertainty, Peter Grandich criticizes Trump's trade war strategy, favoring diplomacy as U.S. influence declines. While reflecting on the market, Peter Grandich notes the Fed quietly bought $40 billion in bonds but still leans toward tightening. He credits the Fed for resisting Trump's early push for rate cuts as the costs of the trade war proved higher than expected. While no formal announcement was made, the Fed's aggressive Treasury purchases have signaled a clear deviation from its public posture of monetary tightening. Market watchers are calling it stealth QE, a soft return to the bond-buying strategy once widely used to inject liquidity into the economy. Far from routine balance sheet management, these actions reflect a growing urgency beneath the surface of central bank policy. Meanwhile, Grandich notes Trump's confrontational approach overlooks the U.S.'s changed role and China's growing strength. He highlights the new trade talks between China, Japan, and South Korea, as well as the closer ties between Europe and China. Let's get back to the interview.
Well, for our planning group, I'm part of a planning group here in the States just for U.S. clients. It's an organization that has about 1.6 billion under management. And my philosophy as the macro guy is it's better to be a live chicken than a dead duck right now. And capital preservation is more paramount, I think, at this point going forward than capital appreciation. Separating that, I also wear another hat, being involved in the most speculative end of the metals and mining industry, the junior resource market. But this is really developing into a division of the world. And while my president, Trump, I admirably appreciate some of the work he's did on immigration and also potentially, hopefully, some sort of better peace in the Middle East. I think he's made a terrible error on the trade war, being a bully after 20 or 30 years of America losing its prominence in the world. He would have been better off carrying an olive branch than a big stick. And I think we're starting to see the kinks in the armor to the attitude that he took. Let's not forget, just a couple of weeks going before his big liberation day, he basically felt that basically the world was going to be the path to his door. And by now, much of the world would have agreed to these wonderful terms he spoke of. And here we are entering June, and there's really nothing yet to speak of. And even the ones or two that they say is happening, we're having a lot of more adversity, especially with China. So again, I go back to that. I've taken a much more caution approach, and I think preservation of capital, especially the older you are, where you have less chance of recovering it if you speculate and unfortunately get caught in a bad market. I just think it's better to be safe than sorry. Well, we also had the Fed quietly come in, not a lot, just 40 billion, but they bought bonds again. And some people thought, oh my God, is this QE again? Well, the difference is, although the Fed chairman went to see the president yesterday, we still have a Fed that's erring on the side of tightening. They are not, don't seem anywhere prepared to flood the gates at the moment. And I think you got to give them credit. I'm not a fan, like I'm sure most of your viewers are not of them, but Trump wanted it on day one to just totally loosen. And they had in the back of their mind, this trade war may be a little bit more longer and more costly than he may think. So we're going to hold off about lowering rates and all. And you got to give him credit. That looked like the right call right now and all. The economy's on I don't know, on the fence, so to speak. There are a lot of things that are suggesting it's clearly weakening. I can tell you this. Our clientele is mostly small to mid-sized business owners. And in the last couple of weeks, they've all said to me they stopped any future planning at this point. They can't possibly plan anything for the future with everything happening, including this with tariffs and all. And I think if it turns now into not just days and weeks, but months, then I think we have a big issue. And while that would normally suggest slowing economy, interest rates are going to go down because things get soft on inflation. The big new player in the room is, can we keep paying the interest? And that is what's getting really concerned. And by the way, that's the few Republicans that are speaking out and the Congress people speaking out against Trump and this big bill and all. That's their lead argument, that we're getting to the point where we may not be able to pay the interest on our debt. I think it's going to become a bigger story as the weeks and months go ahead politically. Yeah, this is what I've been talking about if people visited my X page and all that. This thing, and in fact, I just wrote about it this morning after writing about it a week ago as well. I just think he's been going about it the wrong way. I think he's antagonizing too much and is people want to go out there and think we're not the same country we were 20, 30, 40 years ago. And China is a formidable party. And one of the points that made me think this way, Kai, when he originally started deliberation, two parties went in a room to discuss economics I never thought I'd see in my lifetime. And that was China and Japan. China and Japan, including with South Korea, went in a room to start and form a new trade pact. We also saw the Europeans talk with China in a way that they haven't talked for quite some time about getting rid of tariffs and all. And I just think Trump's overplayed it. And where he did it the most for me, and I know we're going to see this in our Stanley Cup playoffs. Canadians are really going to be rooting for Edmonton now. We really offended our best ally and really a great neighbor to the north. And I'm not sucking up. I mean, Canada was a home away from home for quite a while. But listen, they've been very good. They've been there every time we needed. They fought wars side by side with us. You can go to cross the border many times, not even knowing you crossed the border. There's so much commonality. And they really peed off a lot of Canadians. And I think that's what's happened worldwide. And I don't think Trump has the capability of seeing that. And I think he has a couple of people around him that are too hawkish. I really wish he would just listen to the Secretary Treasurer. I think there'd be a better chance of coming out of this better. But this does not surprise me, this news that you make. And I think China is, been prepared for this and is not going to throw in the towel. He always likes to say, oh, me and Ling, we're great friends. I got to say, based on this, friends like that, you don't need enemies. I mean, it's just his style. And that might work in business, but politically and worldwide with different cultures and all, I think it's a different story. And I think we're seeing that now.
In this environment of monetary uncertainty, commodity-rich regions are experiencing a renewed surge in investor interest. Gold is experiencing a sustained upward trend and could rise to $4,000 to $5,000 in the medium term, with a potential peak of $8,900 by 2030, driven by factors such as rising inflation and global economic uncertainty, as per reports. Given these shifts in global finance, how should individual investors strike a balance between pursuing growth and preserving capital in today's uncertain markets? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.